Hey everyone, Jeff Dorman, Chief Investment Officer and co-founder of Arca, back again for another edition of That's Our Two Satoshis Live, where we talk about everything happening in the digital asset market. And I'm joined by a great guest, someone who I've had a lot of interactions with online, but actually have not had on the show before, Gabriel Shapiro, founder and CEO of Metalex. And it's a good timing because he and I were actually going back and forth on Twitter this morning, debating the rights of token holders and shareholders. And I think he brings a ton of expertise and insights from a legal perspective as well from an investing perspective as it pertains to crypto and equities and the crossover world. So Gabriel, thank you for joining.
Happy to be here.
Fantastic. Well, for those who got a chance to read the Two Satoshis blog this week, we're not going to talk about a ton of that today necessarily, but if you go to our blog on our website, Ar.ca/blog, I basically wrote, where would Hype and Pump trade and some other DeFi protocols, where would these tokens trade if they were actually stocks? And the whole crux of my argument was that very rarely in investing do you get an opportunity to see price go down while everything fundamentally is going up. And what I was getting at is there's really only three sectors that have shown any real growth in crypto. It's basically been stablecoins, it's been DeFi, largely Ethereum-based DeFi, and it's been RWAs. And I put a ton of charts in the blog showing that literally everything's up and to the right? Stablecoin supply and transactions up and to the right. DEX volumes, as well as lending TVL up and to the right. RWAs coming on chain up and to the right. You just see more and more application revenue in crypto rather than protocol revenue, meaning most of the revenue that is being created in the market now is coming from these applications. I think I stole this from Digital Asset Capital Management, but something like 60% of all of the revenue in crypto is now coming from apps, even though these apps market caps only make up 7% of the total market cap. And the question is, does this make sense? Should these tokens trade at such a massive discount relative to the stock market? Should these tokens trade at such a massive discount to the overall crypto market? And is it because of lack of education, or is it because of actual rights that equity holders have versus tokens? So let's start there, Gabriel, because you and I were going back and forth on this. Do you think there is a huge, huge disconnect in the investing world right now between the value you get as a token holder versus the value you get as a shareholder, either for legal reasons or for actual value reasons?
When we're talking about tokens, we're talking about, I assume, ones like Pump and Hype, where the project or the system is buying back, or applying nearly 100% of its revenues to buy back tokens.
Yeah, let's start there. I think that's a good question. That's a good point, because I always say the crypto market is more like the fixed income market than anything, because there's all kinds of different issuer types and token types and
right.
So yes, let's talk specifically around.
Yeah, so we'll call those properly structured app tokens, right? Ones that actually return value. And so, from that point of view, I think there is a. I'm not sure that the outcomes are that different in terms of return to value. In fact, the return to value much better is much better in theory in crypto, because Pump runs a very, very smooth. Hype is a very, very smooth and efficient revenue, right? And the very large have a management and so on. So you need to apply revenue to that, right? And so from a perspective, the crying much harder to return value to their, let's just call them investors, holders, investors, is that to have legal rights, and token holders, at least others, they would argue to you that the token holders don't have any legal rights. Maybe you would come back and say, well, under common law, there's still a substantive analysis of whether someone owes fiduciary duties and stuff. That's possible. But for the sake of argument, token holders don't have rights. They're just sort of relying on this custom that the project has set up of using its revenues to buy back tokens. And the stockholders do have rights. And, I would imagine that, and this may lead to very similar outcomes in fact, But in theory, it's different outcomes. Like, for example, shareholders have the right to elect directors of the project. So if they don't like how the company is being run, right, shareholders can boot them out in theory, or Bill Ackman can come in and take an activist position and boot them out and install new management that would be better, right? And you can't do that with pump funds management, right? There are some differences, of course. Whether they actually play out in financial outcomes, I think, is an interesting question. And I would expect that if Pump.Fun as a company keeps using all of its revenues to buy back its token for a really long time, eventually you would think that the entire market will just believe this will keep happening forever, even though there's not like an enforceable right to it. And in theory, that should mean that they would value Pump just like they would value it if it was a stock, or if not better, right?
Right. So let me jump in for a second, because I think you hit on a couple of words that are key triggers for me, in my opinion. So 100% agree with you that there are legal rights and standards afforded to shareholders, especially under Delaware corporate law, that are not the same as what you have as a token holder. But my rebuttal in terms of does that matter or not comes down to basically two premises. One is that at almost no time does any of this become relevant as a shareholder, in the sense that your rights to the claims of a company tend to only show up when you get bought, which obviously happens all the time. There are acquisitions all the time, and that is a huge difference between stocks and tokens. But two is when the company goes bankrupt. And in almost all bankruptcy cases, the assets left over to shareholders are minimal to zero anyway, because usually creditors take over the company. So as a result, other than the edge cases of a company being bought or a company going bankrupt, when a company is operating as a going concern, almost everything that happens, you're at the full mercy of just what management decides to do, meaning you have no control over, is the management making good acquisitions with their cash? Are they paying their employees too much? Are they making good R&D expenses? Are they, are they blowing the cash on levering up the balance sheet and paying interest expense? Like, to your point, yes, you can go activist, and yes, you can file a proxy battle where you try to change the board of directors or change management. But you can do all that stuff as a token holder too, meaning right now we have no control over what Pump.Fun or Hyperliquid does with their cash flows, but we appreciate what they're doing at the moment, paying 99% of their revenues back to token holders. But also, could you go activist? Like, you can. Arca's done it twice. Arca did it with Gnosis back in 2019 or 2020. Gnosis tokens were trading at 20% of the book value of the Ethereum on their balance sheet. And we spent a year fighting them, saying that you need to tie your token directly to the Ethereum that you hold. And they eventually did. We also did the same thing with Aragon a year and a half ago. We fought publicly through governance with Aragon and said, your project is doing nothing. You are sitting on a ton of Ethereum and your token does nothing. Shut down the company and pay us back. And they did. They paid us 100%. So you don't have legal rights per se to file a proxy and try to take over management of the board, but there are other effective ways of doing it through governance and through social pressure. So again, what I'm not arguing is not that law. I agree with you 100% that there are laws with equities that are different than obviously with token holders, and therefore that should give an entire generic investor base more comfort. But in practicality, most of the time you're not operating on either end zone.
I agree. I mean, more often than not, you're relying on incentive alignment and social pressure and that sort of thing in both cases, rather than on lawsuits. I think that is true from a pragmatic perspective. I do also think that there is, I would push back a little bit, as having been, I've been a crypto lawyer for, I don't know, 7.5, 8 years, whatever. But before that, I was a public company, buy side M&A lawyer, right? And albeit a lot of my work was in the merger space, and so merger is the context you're talking about where the rights do matter. But I do think that, management talks to its lawyers and they talk to their independent board members, and fiduciary duties and things like that, and the possibilities of getting sued over certain things do come up in those conversations and do get weighed, even as improbable and unlikely as it is that a lawsuit would happen, or that if it happened, it would be successful. Because, of course, the other thing is that the business judgment rule, which is the rule of deference to, a Delaware corporation's management in their business decisions as against any stockholder complaint, has gotten broader and broader and broader over the years, so that it's very hard to sue these companies or to second guess their decisions. And even in like the one recent case where the business judgment rule wasn't honored, and it was against Elon Musk because he arguably is a control person or whatever. He got so mad about that he was able to create like an exodus of companies from Delaware. And so I feel like no judge is ever gonna dare to like penetrate the business judgment rule again unless it's like fraud, right? So to your point, all these things are eroding the rights and making tokens more similar to stock, in effect.
Well, and effectively what you're saying, if you dumb it down for people who are not legal experts, you're basically saying the burden of proof to prove that a company is not being a fiduciary is very hard, right? Like, so again, what I'm arguing in layman terms is like, no matter what you invest in, whether it's stock or it's tokens, at the end of the day, you're pretty much at the mercy of management decisions, and a lot of your investment success or failure is going to be based on, did you back trustworthy managers who are trying to increase the value of your stock or of your token? And I think that's the big one for me is like, I have no problem if somebody says to me, I don't trust that Hyperliquid's going to continue to pay 99%, or I don't trust that Hyperliquid management is in this for the long haul, or I don't trust that Pump Fund is going to be a business that sustains for all. But when people say Pump and you're not getting any benefit as a token holder because they could turn off these cash flows to token holders whenever they want, and legally stocks have all this rights. I'm like, well, that's not true, because as a shareholder, they could turn off the dividends or buybacks whenever they want to. Like, I feel like there's just a lot of like broad-based arguments that when you actually get in a room and talk about it, they just don't hold up in 99% of the cases. And what I kind of come back to is, I want to back companies and founders and teams that I think are aligned with me and I think are doing the right thing with regard to their cash flows. And the instrument itself at an individual investment level really doesn't matter to me. But holistically as an asset class, there's no question that the equity market is built on trust and laws and things like that. And that's why there's way more money invested in equities than there are in tokens. So it's sort of like, I'm not dismissing that the laws and the governance of equities are better than tokens, but on an individual case-by-case basis, it's often very hard to find.
No, it's a fair, I think that's a totally fair sort of, pragmatic take. And it's also a good reason for your argument of why you basically, because of your argument, you can't explain the gap in performance between a comparable equity and a comparable token in terms of price, just by virtue of that legal gap, because that legal gap doesn't matter enough in most situations to be the explanation for that, right? It's either that people are not understanding that issue. So it's basically the difference between a legal rights bearing investment and a non-legal rights bearing investment is somewhat FUD, but people are crediting the FUD, or it's for some other reason that I don't know what it is, but it isn't probably because of the legal rights themselves, because they usually don't in fact matter even for the ones that have them, right?
Right. And the joke I was making is like, congratulations on all your laws and regulations if you were a WeWork shareholder. Right? While WeWork management went out there.
Yeah. Well, part of that was, it was a private, part of that, it's a very different context when it's a private company as well, right? Because, you get all these insiders and the VCs don't want to screw each other over, or like, private is very different. And probably the right comparable is public, right? Because tokens are freely trading. But yeah, again, I get it for sure.
Yeah, but you could also apply that to public. Like, look at some of the casinos back in 2007 that were LBO'd, and like Harrah's and Caesars is a great example, right? Levered. They were like 1 times levered prior to the 2008 recession. Then here comes TPG and Centerbridge, and they LBO it and put 10 times the debt on there, and then ultimately they go bankrupt 3 years later. It's like all the rules and legal protections in the world didn't change the fact that management massively screwed up. They levered up at the wrong time. And as a result, shareholders got killed, right? So like there's all kinds of kinds of examples in the markets where
you wouldn't want to expose your playbook, but if people knew more of the details of how you pressured Gnosis and Aragon, maybe they would gain more confidence that in fact you can assert your rights as a token holder. What I imagine you probably did is have a lot of duty, arguments based on common law, that fiduciary duties may apply. Maybe some securities law stuff as well, because they did fundraisers during the first ICO wave where people weren't very careful about that sort of thing.
Yeah.
So you probably had some leverage.
I mean, quite frankly, we also just use the Court of Public Appeals quite a bit in the sense that
Right.
we put out so much information. In fact, you can Google this. You can Google Arca, Gnosis, activists.
I've seen it. Yeah, I've seen them. Yeah.
Yep. We have case studies on our website. There was definitely some legal pressure, but the majority of it just came from rallying other token holders to point out that these guys were not doing anything by their token holders, and eventually they succumbed to the pressure of the social. Now it can go both ways, right? They can also say, "That's it. I'm going to take my bag and walk away and screw you." Like, it's not necessarily always going to work, but
right.
we didn't. There were no laws or regulations that we hid behind in these campaigns. It was simply, you guys are failing your token holders. Once you issue a token to the public, you have an implicit, if not explicit, fiduciary duty to those token holders. And if you fall down on that responsibility, we have the right to complain and try to force change. And you don't have to necessarily listen. There was no proxy fight that we could have legally done. But the end result was the same. As we put a ton of pressure on them.
Moral suasion, as we call it, goes a long way indeed. Yeah, I can see that for sure. It's becomes more of a street fight than a legal fight, but in some ways, that can matter more. Yeah, it's very interesting. I do the arrogant lawyer in me does wonder, if you did that to one of my projects that has like better fiduciary duty disclaimers and things like that, right? Would it work as well? And I don't know, but it'd be interesting, and maybe it'll happen one day.
Well, I think a lot of it also then just comes down to, like, what is the purpose of the token in the first place? Like, clearly, if you back a team or a company or a founder who they're just issuing the token to max extract and then they're going to walk away from it and nobody cares about it ever again, you're obviously not going to have the ability to.
Or they're using it, like Uniswap up until very recently arguably did. They're using it basically to bootstrap their equity. You know what I mean? Which, with like a lot of these VC-backed projects, had the dual equity token model, and basically when it came time to, basically they treated their protocol as like public goods for a long time, and they were able to subsidize that by the market sort of irrationally highly valuing their token for, like, maybe in the hope that one day it becomes value accruing, and then they basically use that to, subsidize their equity holders. And I think, frankly, a lot of them had been planning to also do an equity IPO and get what one VC's lawyer in 2020 described to me as, we like the double dip. We could get token and we could get equity, right? But that naturally creates a lot of conflicts of interest. And I think now, with Uniswap being the king of that model and finally going token only, we'll hopefully see the whole market move toward that, because people tend to follow Uniswap.
Yep. Well, I mean, you could also make the argument that the most successful token and possibly equity in all of crypto was Binance, where they have a dual model.
Yes.
Binance has shareholders and equity, and Binance also has a token, and they have found that middle ground where both are happy. Now, to your point, it's often at odds with each other, right? It's hard to placate both your token holders and your shareholders, but it is possible. And a company as big and as power and as well run as Binance has been, did figure that out, right? They found a way to make the token a priority in their capital structure, to find ways to increase the value of the token through, a portion of their revenue, through the utility from Binance Smart Chain, through using it, as collateral on their exchange and things like that, while also still having plenty of profits to go along to their equity holders. And if the question is, well, shareholders are, therefore losing at the expense of token holders, the flip side of that argument is, well, maybe the shareholders wouldn't have made as much money as they did if it wasn't for the fact that they entitled the customers with the token. So we don't know. I mean, there's just not enough case studies yet, but there are.
I mean, we're about to get a good one with Coinbase, right? And that one will be from a public U.S. Delaware corp. I guess they're becoming a Texas corp, but the laws are very similar. So, obviously much stricter environment with more potential for lawsuits, from equity holders, for example. And it'll be interesting to see how they navigate all that and how it plays out. But my guess is shareholders will end up liking the token.
Yeah, I mean, for those who don't know, I mean, Coinbase has basically announced that they're going to issue a base token for their layer 2 blockchain. And it's going to be really interesting, right? I mean, you can make an argument as a Coinbase shareholder that you should get 100% of that base token because the IP and the property while building that at Coinbase is 100% yours. But on the flip side, we all know that if a token of an L2 does not also get distributed in some way, shape, or form to the community, it's going to go to zero anyway. So it's like, here again, now you have this tug of war. How do you placate the shareholders and how do you placate the token holders? And there are ways to do this correctly. Like most people have heard me say 1,000 times, like I think Disney will have a token one day that skims a little bit of the top of their revenue, but also gives you rights to Disney, gives you discounts on Disney Plus and gives you discounts at the parks. And I think Netflix will have a token one day. I think I really do believe that there will be a day in the future where every company has both debt, equity, and tokens in their capital structure. And does figure out a way to do it.
Yeah.
So anyway,
I do believe that as well.
So back to the argument I was making about is it really that different to be a token holder than a shareholder? Like, this is where it got really interesting for things like Hyperliquid and Pump, and there's others as well. Your Aves, your MakerDAO Skies, your Aerodromes. Like I put a lot of them in the blog for people who want to read it. But like we've never seen before the revenues and profits going up as fast as they are, while prices are going down as fast as they are. And the question remains twofold to me, right? One, why isn't this industry more focused on the revenue producing crypto apps that are actually growing and trying to tap into this massive debt and equity fundamental buyer base that is much bigger than the macro VC kind of tech world that we focus on with Bitcoin? And two, more importantly, is if these assets were actually stocks, how much higher would they trade today? Meaning like Robinhood trades at like 50 times earnings and basically only has twice as much earnings as Hyperliquid. Like, Robinhood's trading at 5 times the value of Hyperliquid.
And how many X does Pump trade of its earnings, or is it actually under?
I mean, yeah. So Pump's another example, right? Pump does about $1.2 billion of run rate revenue right now, of which 99% is being used to buy back the token, and the market cap, the circulating market cap of the Pump token is 1.6 billion. So if you want to go fully diluted, which is probably more accurate, it's 2.8. But you're looking at something that trades at like, somewhere between 3 and 4 times. Like where would, if you think about like, if you go back to Facebook's IPO back in like 2010 or 11, whenever that was, like most people didn't understand the Facebook model. The IPO priced at 40 and went to 20 right away before ultimately going up, 40x over the next 15 years. But like people didn't understand the Facebook model. They didn't think these revenues were sustainable. They didn't think people were going to always log on. Like the same kind of thing is true of Pump.fun. Nobody really understands meme coins. They don't know if this is going to be a sustainable business. So like maybe these discounts are warranted, but how much of a discount are you really supposed to get on tokens that are more or less equity-like tokens just because of the legal rights? So like that's the question I was kind of posing to everyone is when you see chart, I have a great chart of Hyperliquid in there, for example, where like you have never seen a bigger disconnect right now between the volumes and revenues of Hype relative to the price, basically meaning the PE ratio is the lowest it's ever been. Like when do growth equity investors start looking at the space? Is it like, do you think they are 100% just, they are reliant on market clarity and laws and regulations, and they're just never going to get past that? And it's like, in order to build a real buyer base of this asset class, you have to put the same rules and regulations in as the debt and equity markets, even though intuitively, as we just spent 20 minutes talking
about,
it's not that different.
I doubt it. I mean, as crypto is getting more institutional, over the last couple of years, what me and a lot of other people end up talking about is Wall Street's actually pretty degen. Like if you talk to the actual people at Wall Street, like they have pretty degen inclinations actually. So my guess is, where there's opportunity, they're going to come in, and you're making a compelling case for why there's opportunity, right?
Yeah, so I appreciate that. And I think you're absolutely right. I mean, I worked at a hedge fund 15 years ago where people were trying to track down individual life insurance policies of like old people that were about to die. So yes, Wall Street's pretty deviant. They'll look for ways to make money.
And there are also things, I think the governance is improving as well. Like one of the things I work on at my project Metalex is what we call borgs, cybernetic orgs, right? And a big part of the purpose of, like we just did a setup for MetaDAO on Solana. We've done ZK Sync, we've done a number of them. And a big part of the purpose of them is to have legal rules in the foundation docs that do make the entities accountable to token holders sort of officially in certain circumstances, right? Like, if you want to, basically do something with the IP of the project, right? Like you might have to get a DAO vote for that, or if you want to do like an upgrade of a protocol that everyone is depending on, the DAO might have like a veto over that. It might be time locked, and the DAO might have a veto, and that would be in the legal rules, as well as in the system. Or if it's like a multi-sig that has certain protocol authorities to like change parameters of a system, there may be a rule in the legal documents that says, well, you're only supposed to change them like for true security emergencies, not just because, like as we've seen in many credit protocols, the founder has their own position in the credit protocol and wants to bail themselves out or something like that, right? So I think that the market is also adapting, is creating its own legal accountability structures that are outside Wall Street, and outside the fiduciary duty context, but are more contract based and sort of operate a bit like trusts or something like that. And so that's an avenue as well through which people, can get more comfort, that there's some protection.
Interesting. Yeah, it's like MetaDAO keeps coming up over and over again. In fact, we're about to do investment committee here at Arca in the next couple of days on it because it just keeps popping up.
Excellent.
So it's really interesting, and I think it aligns really well with what we're talking about. So before I let you go, Gabriel, one thing that I'll shout out Arthur.hl on Twitter. He said, I think crypto today is like the stock market 80 years ago. Companies can trade at a low multiple for a long time, but lower PE ratio tokens will outperform over time. And you can definitely be a value investor in crypto because there's just no value investors out here to bid up the prices. And it's effectively similar to what we've been talking about here, right? Which is that when you're talking about Pump Fund, or you're talking about Hyperliquid, you're talking about Aerodrome or Aave or any of these other like apps that are creating real revenue and driving real value back to the tokens. Just because they exist doesn't mean the buyer base is there yet. And I think the industry in general has a lot of work to do to start to educate and teach. Like one of the things I've been saying over and over again is like, most of this industry was built on Bitcoin and on Bitcoin forks and maybe a little bit on smart contract platforms. And as a result, even just the nomenclature we use on like market cap and FDV, the way people talk about inflation, it was built around assets that are that don't incorporate all the new types of assets that exist now that we have amortizing tokens instead of inflationary, now that we have companies issuing tokens instead of just protocols. So I think there's just this sort of evolutionary gap right now between what has actually happened in crypto versus the way we describe and educate investors about it. And I think, quite frankly, the big exchanges, the big OTC brokers, the big firms, the onus is on them with their platforms and their size and their resources to do more of an educational campaign to separate the Bitcoins from the smart contract platforms, from the DePIN tokens, from the DeFi apps, from the meme coins. And so people stop looking at this as just one giant asset class, because it's not, right? It's really more of a technology or a wrapper.
For sure.
That houses all kinds of assets and possibly even asset classes. So anyway, I'll leave that with the audience there in terms of like, I think the industry needs to really focus on the few sectors and the few tokens that really are providing value, and have these debates and figure out like, what does it take to get investors to look at this stuff, because there is real value here. So with that, Gabriel, I appreciate you coming on. I'll leave that with
my pleasure.
Where do you want people to find you? Where can they read more about what you're working on? Where can people?
Yeah, sure. I'm Lex Node on Twitter. That's LEX_NODE. I'm pretty much always there. And I have a project called Metalex that basically turns companies into robots using smart contract technology. So we automate your financing round and your cap table and good things like that. And you can check out metalex.tech for that.
Fantastic. Well, enjoy your rest of your time down in Buenos Aires. I appreciate you coming on short notice. And everyone else, we'll see you next week. And you can check out our blog.
My pleasure.
If you want to see more charts and graphs supporting the argument. So thanks, everyone.